Good morning, hunters. Welcome back to the Daily Hunt for Multibaggers on this Tuesday, February 24th, 2026.
That's right, Ethan. We've just crunched the numbers and analyzed a significant volume of market commentary from yesterday, February 23rd.
And what a day it was, Brooke. Our AI flagged quite a few different stocks, and the overall sentiment out there is a real mix. A lot of speculative buzz, but also some serious caution.
Indeed, we're seeing some promising growth stories, but a healthy dose of risk management is going to be key, as always. Let's dive right in.
Kicking things off with IBM. There's been a lot of social media chatter. Some users are trying to downplay the impact of this new Anthropic AI tool. They argue that the complexity of legacy COBOL systems, plus IBM's diversified portfolio, means this isn't an immediate death blow. Plus, we've seen some insider buying activity, which always instills a bit of confidence for a potential rebound.
Well, Ethan, confidence is one thing, but the numbers tell a stark story. IBM just saw its steepest daily drop since 2000, plummeting close to its 52-week low. Our AI insights confirm that this Anthropic AI is perceived as a very real threat to IBM's legacy modernization business. And let's not forget that extremely high debt-to-equity ratio of nearly 200. That's a significant financial risk. The previous ratings for IBM have mostly been stay away since late 2025. And frankly, this news does little to improve that outlook.
So even with some insider optimism, you're saying the risks outweigh the potential rebound?
Absolutely. The market has reacted severely, and the underlying KPIs, particularly that debt and low revenue growth, don't provide much comfort for the future if this AI threat truly materializes.
Final verdict for IBM?
Stay away. For now, the risks are just too pronounced.
All right, let's talk Microsoft, MSFT. Always a heavyweight, and our analysis shows a cautiously bullish lean. Wall Street analysts are calling it a consensus buy, citing strong fundamentals, steady revenue, and their deep involvement in AI and cloud. We've also seen significant insider buying, which is a fantastic vote of confidence from those who know the company best.
Ethan, I agree on the long-term potential, especially with that impressive 16.7% revenue growth and nearly 40% net profit margin. Those are solid numbers for a company of Microsoft's size. However, some user discussions flag short-term bearishness, with talk of the stock falling further due to rising capital expenditure from their AI investments. And while it's only one report, one of our analyses did highlight a notably high debt-to-equity ratio of over 31.5, which is something to keep an eye on for a tech giant.
But surely their strong strategic position in AI, coupled with those consistent financials and insider confidence, means those short-term wobbles are just noise for a long-term play. Their recent ratings have been mostly buy. For a patient, long-term investor, potentially yes. The AI initiatives are investments for future growth, and the insider buying is a powerful signal. So the current dip could be an opportunity then? For a patient, long-term investor, our AI-generated insights suggest a buy. Nvidia, NVDA. This one popped up as a real bright spot in a challenging market yesterday, Brooke. It climbed over 1.6% ahead of earnings, and one analyst firm even upgraded it to a buy, calling it undervalued. Everyone's buzzing about their AI-driven data center demand. This feels like a clear winner, doesn't it?
Well, Ethan, their revenue growth at a staggering 62.5% and a net profit margin over 53% are undeniably phenomenal. That's a powerhouse. But undervalued with a PE ratio nearing 47 and a price to book over 39, that's a very high premium, which shows the market is already pricing in a lot of future growth.
But with AI demand surging and expectations for strong Q4 results, that premium could be justified, right? Strong earnings would lower the forward PE, showing that the growth is indeed there. Their previous ratings have often been a buy or cautious buy.
Yes, the market is certainly confident in their ability to execute, and those future developments could very well improve the valuation metrics. So while I'd always caution on high valuations, the growth story here is compelling.
Final call on Nvidia?
Buy.
Let's pivot to Corsair Gaming, CSRS. An interesting one, with one user going all in after 5 years of pain, citing a Q4 earnings beat and a stock buyback. Plus, our analysis noted significant insider buying and a price-to-book ratio below 1, suggesting it could be undervalued.
Ethan, that's a very optimistic take, but the social media discussions are predominantly bearish. Users highlight that CSRS is a price taker for DRAM and NAND, meaning they don't control their own component costs. Then there's the concern about weakening consumer demand for PC builds due to high prices. And the KPIs, negative net profit margin, negative EPS, and an extremely high debt-to-equity ratio of over 27. It was stay away last time we checked, and those fundamental issues haven't resolved.
Even with the Q4 beat and insiders buying, couldn't that be a sign of a turnaround? Those are positive signals, but they're overshadowed by significant financial fragility and market structural challenges. Until we see sustained profitability and a clearer path to debt reduction, the risk profile is simply too high. So the verdict? Stay away. Robinhood, next up. This one is generating a lot of buzz. We're seeing massive insider buying, over 46% net shares purchased in the last 6 months. That's a huge vote of confidence. Plus, their new $1 billion fund for pre-IPO access could be a game changer, attracting new users and diversifying revenue. Cathie Wood even got the dip. Strong growth potential here, wouldn't you say?
The insider buying is certainly compelling, Ethan, and their revenue growth of 26.5% and 42% net profit margin show a strong core business. However, users are also calling it PayPal all over again and expressing concerns it will go nowhere due to oversaturation by retail investors. And let's not ignore the incredibly high beta of 2.44, meaning extreme volatility, and a debt-to-equity ratio of 136. These are significant financial risks. Its previous ratings have often been stay away or speculative gamble.
But these new initiatives and insider confidence could lead to a substantial improvement in those metrics, couldn't they? That pre-IPO fund, if successful, could totally change the growth trajectory.
It absolutely has the potential to, which is where the community optimism comes from. But the existing high valuation and severe risk factors mean it remains a high-stakes play.
Final word on Hood?
Stay away. The risk is too high for a general recommendation, but it's one to watch for those with a high risk tolerance. Novo Nordisk, NVO. There's chatter about the widespread need for weight loss solutions, and some users are buying the dip, seeing potential in their pipeline.
Ethan, the social media sentiment is overwhelmingly bearish. Our AI insights confirm this. Users are openly saying NVO is losing its edge to Eli Lilly, citing superior GLP-1 drugs from LLY. The news yesterday underscored this, with NVO's obesity drug, CagriSema, failing a trial endpoint, and the stock plunging as a result. Their revenue growth is actually negative, and they're facing patent expiration soon. The current price is near its 52-week low for a reason. Its past ratings have been mixed, but this new development is a clear negative for its buy ratings.
So despite the market size, they're just getting outcompeted?
Precisely. The competitive landscape is shifting dramatically, and NVO is not on the winning side, at least not right now.
Verdict for NVO.
Stay away.
Hims and Hers, HIMS. Historically, this company has shown impressive revenue growth, around 49%, and decent EPS. We're also seeing significant insider purchases, nearly 33% net shares bought in the last 6 months. Plus, they expanded with the Eucalyptus acquisition. Sounds like a growth story.
Historically strong, yes, Ethan, but the future outlook, according to our AI and social media discussions, is grim. Users are predicting further declines, and the market reacted very negatively to their Q4 earnings, despite a beat, due to weak guidance. They're facing a DOJ investigation, a patent lawsuit from Novo Nordisk, and the FDA has closed a major loophole they used for compounded weight loss drugs. That's a triple threat.
Wow, those are some serious headwinds.
Extremely serious. Their debt-to-equity ratio is a staggering 192, and future revenue growth is projected to slow dramatically. The stock is currently trading near its 52-week low. Previous ratings have consistently been stay away or speculative gamble, and these new developments only reinforce that.
So, despite the insider confidence, the external risks are too high.
Far too high. The fundamental business model is under attack.
Final verdict for Hims?
Stay away.
Lastly, PC, or premium catering. Now, the analysis we got for this one seems to be referencing a gaming hardware company, which is a bit unusual for a catering business name. But looking at the data for what's described, we see a user all in and a mention of secured supply and potential tariff refunds.
Ethan, regardless of the company name discrepancy, the data points to a highly risky situation. The analysis describes it as a price taker in the memory market, lacking manufacturing control. It's grappling with negative revenue growth, a completely negative net profit margin, and an extremely high debt-to-equity ratio of almost 10. Users are very bearish, citing a history of investor losses and declining consumer demand for PC components. We also have no insider trade data for PC to confirm that bullish signal mentioned.
So the underlying financials don't support the optimism, even with the speculative hopes for tariff refunds?
Not at all. The debt combined with consistent unprofitability and shrinking revenue makes this a clear red flag.
And the verdict for PC?
Stay away.
All right, that was a packed session. Let's round it up for today's hunt.
Here's our AI-generated compiled list for deeper analysis. Investigate as buy, Microsoft Corporation, MSFT, Nvidia Corporation, Nvidia. Investigate as cautious buy, none. Investigate as speculative gamble, Robinhood Markets Inc., Hood.
And that wraps up another episode of the Daily Hunt for Multibaggers.
Before we go, a quick but very important disclaimer.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Absolutely. Thanks for tuning in, everyone.
We'll catch you next time on the Daily Hunt.